Wouldn't it be nice to know what's going to happen before it happens? Wouldn't it be fantastic to be able to make decisions now and over the next few months about what's likely to happen over the course of the coming year? Well, that's what we're going to try to do in this video. This is the 2024 real estate market forecast for Las Vegas. I am Justin Miller, co-founder and principal at the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. I used to be a business school professor, and so that means I've got PhD level knowledge of business, of economics, of statistics, and I bring that to bear in the advice that I provide to my clients and the advice that I share with a somewhat wider audience here on YouTube. And so while it's true that looking into the future is something that carries with it risk, forecast may not be correct for certain various reasons. If you actually understand what's going on in the marketplace, what's driving the conditions in the marketplace, we can have a lot of insights about what's going to occur in the future. The easiest way to engage in forecasting is straight line forecasting. What happened today will happen tomorrow, will happen the following day. Or the growth we've seen over the course of time is going to simply continue. But we can modify those straight line forecasts to capture a lot of other things that are going on in the market. And so that's what I'm going to do here. So to start this process, we need to have a pretty good understanding of where we're at right now. So as I record this video, it is Thanksgiving week 2023. So we have the majority of the data for 2023 under our belts, which is good because nothing may fit under our belts after we feast at Thanksgiving. Anyhow, what we don't have is we do not have final numbers for the month of November, and we don't have any information specifically for the month of December. But where we've gotten to through the course of the year 2023 to date, one, we've seen price growth from February of 23 all the way through the end of October. In fact, prices at the median for single family, resale, residential here in Las Vegas Valley ended October at $442,000. That is up 6.5% from where we began the year on the 1st of January at $415,000. So prices have gone up this year, much to the contrary opinion of a lot of people that you may listen to on YouTube or read, frankly, in the newspapers or on other social media. The reality is, as I had predicted a year ago, 2023 was going to look weak in the first half of the year and was going to look quite good in the second half of the year. And that's come to pass. And so prices, as of the end of October, up 6.5% from where they were at the beginning of the year. Now, I will note to you, of course, prices are down from where they had peaked in May of 2022. They had peaked at $480,000 for, again, single-family resale residential here in the Las Vegas Valley. So we are down from that, but we've recovered almost half of the decline that we saw in the second half of 2022. So we've come back up. And we've seen a story of price growth throughout this year, throughout 2023. Well, we've also seen another story, and that is we've seen wildly increasing interest rates. Interest rates started 2023, 30-year fixed rate mortgage loans at about 6.42%. And at the end of October, they had actually gotten to 7.9%. That's 1.5 points or 150 basis points higher on the 30-year fixed rate mortgage loan than what we had seen at the beginning of the year. That's a really big increase in mortgage pricing. And that has taken place not in a straight line, but over the course of time during the course of 2023. We've seen increases and decreases, and mostly increases. Now, I will note here we are in the third week of November, and mortgage rates have come down to 7.6%. That's the average across the U.S. according to the Mortgage Bankers Association. So that is actually down about 30 basis points from where we had gotten to at the end of October. So that's good news. Rates have come down a little bit. That's actually increasing mortgage applications a little bit and slightly increasing mortgage refinance applications a little bit. So that's good news. The question, of course, is what's that going to look like next year? And we'll get to next year in just a minute. Now, I do want to comment, though, while we've seen prices, the sale price of a home, go up by 6.5%, because interest rates have also gone up, the cost of carry, the amount that a person's actually paying every month to buy that home, and let's say they're buying with a 90% loan-to-value mortgage, so they put down a deposit of 10%. They borrow the other 90% on a 30-year fixed-rate loan at the average interest rate that's available on the median home price. That median home has gone up by 23.1% this year in terms of the cost of carry. That's staggering, right? So median home price went up by 6.5%. That's what buyer and seller negotiate. But the interest rate has also gone up, and it means that the buyer is paying literally now in November 23.1% more for the same house than they were at the beginning of January in 2023. So you can see that this really sharp escalation in the cost of housing likely has had a very big impact on the amount of housing that actually sells. And so you're right. The number of transactions, the number of sold, and the number of pending contracts that have not yet closed, but buyer and seller have negotiated on, those have come down. And in fact, at the end of October of 2023, we were seeing sales volumes that were lower than any time within the past 15 years, with the exception of November and December of 2022. Very, very slow market as we end the year 2023. Something to think about, and we want to think about what that implication may be for the future. Now, there's one other really interesting statistic I do want to talk briefly about with regard to 2023, because it says something interesting about what's going on in the marketplace right now. Usually, we see in the Las Vegas Valley new construction housing comprising approximately 10% of total sales, 10, 11, 12%. The other approximately 90% are resales of inventory homes. And the statistics that I use are always about the resale homes. Overall, we can look at housing completions, we can look at new home starts, we can look at building permits, and those three data points tell us how large the overall new construction market is. And therefore, we know how large the overall new construction market is relative to the resale market. Normally about 10%. In 2023, because the inventory of resale homes has fallen so far, we've actually seen new construction homes move from 10% of the market to literally 32%. Almost an entire 1/3 of the housing market in Las Vegas in 2023 has been new construction. That's really interesting. And it poses some challenges for us as we think about how the market looks and how the market may respond in the future, whether you're a buyer or a seller. Now, I will point out the total number of new construction homes in Las Vegas in 2023 that have been built is likely going to end December, so 5 weeks away from now, at just about 11,100. Now, that number is meaningless in and of itself because you don't have something to compare it to, except that it's a third the size of the overall housing market. The other thing I'll point out is that when we were looking at the peak for new construction housing in the Las Vegas Valley, we were looking at over 36,000 new construction homes, more than 3 times the rate of new construction that we have right now. Interestingly, we've got to go back to 1991 when the valley was about 550,000, 600,000 people. So a quarter the size of the valley now, before we find as little new construction housing production as we're seeing this year in 2023. Now, new construction is impacted by interest rates, it's impacted by buyers being able to buy or not, but it's impacted in different ways. And we're going to talk about that a little bit as well, because we want to look at the overall marketplace as we start to forecast for 2024. So that brings you up to speed. That sort of level sets. So we're all starting at the same place as related to 2023, while we start looking forward and trying to figure out what's going to go on in 2024. Now, while we start to look forward, the first thing we want to talk about are going to be those things that are influencing the housing market. The predominant factors that are actually driving what's taking place in the housing market right now, because that's going to give us great insight into the kinds of factors that we need to be paying attention to as related to 2024 and as related to our forecast of what's going to actually take place in 2024. So what's the first, and I would argue the largest influence in the marketplace right now for housing? Interest rates. So the U.S. Federal Reserve in early 2022 decided they were going to start tackling the inflation problems that were emerging in the U.S. economy as we started to fully recover from the pandemic. We started to see high levels of demand across a wide range of issues. You may remember, if you think back to 2022, restaurants were reopening and lots of people were going to restaurants, and you couldn't hardly get reservations even to go to McDonald's, and certainly for really nice restaurants. And everybody was trying to go to these places, but not all of the employees had decided to come back even when they were being offered their old positions. Some employees decided they did not want to work in those service industries any longer. They wanted to do something else. Others decided it was too risky to be in those kinds of environments, and so they wanted either more compensation or they wanted to go into something perceived as being safer. Well, it wasn't just restaurants. It was travel, right? We've seen this materialize, and I might say metastasize, over the past 18 months, where there's been huge amounts of travel domestically, but increasingly internationally as well. You may remember last summer, a massive problem across all of Europe, where airports all over the European continent were losing luggage because luggage delivery systems in airports could not connect luggage to passengers quickly enough. So people were going through the airports and their luggage was being stuck and left behind, not making connecting flights or not getting to people as they arrived to go back home or things like that. It was a complete mess. It's happened in the US as well, not quite as badly as it did in Europe. Well, we saw a lot of that, right? We saw all of this demand, and we saw that demand being met with limited supply of the ability to deliver luggage, supply of the ability to seat people in restaurants, supply in terms of the ability to get people into hotel rooms where hotels may have only opened fractionally and then larger fraction and larger fraction before being fully open. We saw it with cars, where production of computer chips that would go into cars was way behind, and the ability to ship those computer products across the globe was highly constrained. And so cars were piling up, partially built at factories, because the cars could not be completed without the electronics that go into them. And so car prices started to go up. And in fact, used car prices rocketed higher because used cars were functioning cars that had the electronics that were already installed, and so they were available. So the US Federal Reserve looked at this and said, wait a minute, we've got prices increasing. We need to do something about this. The US Federal Reserve is an organization which was created to deal with the growth of the US economy, created back in the early 1900s. And it has effectively two mandates, sometimes referred to as the dual mandates. One is to maintain full employment in the US economy, making sure that we don't go into a depression, that people have the ability to be employed in the economy because the economy grows quickly enough to absorb new entrants and to keep existing employees employed. Their other mandate is to restrict the level of inflation so that prices are not going higher at a rate that is difficult for Americans to accommodate. Right? If you went out to buy a TV today at $1,000 and you didn't see the one you liked, and you went out tomorrow to a different store to get the one you liked and it was $2,000, there'd be a big problem. So the Federal Reserve tries to minimize inflation while also maximizing employment. At least that's their mandate. The Federal Reserve is actually not particularly good at balancing these two mandates historically. The Federal Reserve tends to drive down inflation too far and too quickly, which causes unemployment levels to go up, employment levels to go down, unemployment to rise, which then causes the Federal Reserve to try to do things to increase the inflation in the environment. Because if we have inflation that's negative, for example, that's even worse. So if you went out to look for a TV today and it was $1,000 and you decided, I'm not going to buy it because tomorrow I could get it for $800. And tomorrow comes along and you decide not to get it because you could get the same TV the next day for $600, right? You would keep putting off your purchase. So it's important that the US economy actually has some level of inflation. That level of inflation right now is contested. The US Federal Reserve right now is trying to get the inflation level down to 2.0%. Historically, that's actually really low. Historically, inflation in the US economy has been something between 3 and 3.5%. So the Federal Reserve's target right now is kind of weird. It's too low, and it means that the Fed is doing too much to try to bring down inflation. Well, inflation peaked in May of 2022. On a single month, inflation on a year-over-year comparison peaked in May of last year at 9.1%. Inflation has fallen since then, and in October, the inflation read that came out just a couple weeks ago says inflation is running at 3.2%. So we're actually, inflation-wise, running very much in the norm of what the US economy is generally running at. But the Federal Reserve has decided, no, we need to keep fighting inflation. Well, how does the Fed fight inflation? Their primary tool is by increasing interest rates. When you increase interest rates, what you're doing is you're increasing the cost of money. So if somebody needs to borrow money to buy something today, to make an investment today, it became more expensive. Just like that median home went up by 23.1%. That's a lot more expensive to buy the median home now in November of 2023 than it was in January of 2023, right? That almost 25% increase took place over a 10-month period of time. Very rapid increase in prices. Is that inflation? Well, actually, you could argue that is inflation. Now, the housing inflation number is actually rent. Rent's not going up quite as quickly, but rent is actually going up. Why? Because the cost of building new houses, new rental properties, is going up because the cost of the money necessary to build those houses is going up. And so a developer needs to be able to charge more for the rental stock for somebody to move into. It actually turns out that while the Fed has been trying to curtail inflation in this economy by increasing interest rates really dramatically, what they've actually done while pulling inflation down some is they've actually caused housing costs, shelter costs as they're referred to go up at the highest rate of anything in the so-called basket of items measured in the price index, in the inflation index. What that means is the Fed is now fighting against itself, raising interest rates to try to contain inflation, but inducing the very inflation that they're trying to contain. Problem. It's a big problem. So what do we have right now? We have a high interest rate environment, and that has caused the carry cost on housing to go up very significantly. The impact of that has been to drive down the number of transactions because housing is less affordable, because buyers may be thinking, hopefully soon, interest rates will come down and I'll be able to get a better deal, maybe. They're also harming the supply side of the market because the seller of a house is usually the buyer of a different house. And a seller who's thinking, if I sell my house that I have a 3% mortgage on and have to replace it with a house that has a 6% mortgage, why would I want to do that? So that's actually pulled some inventory out of the market that would normally be there. So high interest rates making it harder for buyers, high interest rates making it conceptually more challenging for sellers is really limited inventory. And so that's the second really major influence that we've seen in 2023 is very low levels of inventory. Inventory has actually fallen between 50 and 60% over the past 12 months from where we were in September of 2022 to where we are now at the end of October, beginning of November of 2023. We've seen inventory coming down by 57, 60, 63%. That's a massive decrease in inventory. And that means that buyers are looking at fewer properties to the extent there's multiple buyers out there that may be competing on those properties that are available, or those buyers may not even be finding the kind of property that they actually want. And so that's pulling down the level of sales in the environment. This is a big factor we have to pay attention to as we go into 2024. And then the third issue, and I've alluded to it already, the third major issue as we look forward is new builds. New construction is interesting because it takes place when a developer decides to buy some land, go through the permitting process, put in the underground utilities, and then start to build the actual property. It takes a while, in fact, to go through the entire process under good supply conditions takes about 18 months start to finish for the process. The actual building of the individual house, again, under easy supply conditions, takes something on the order of a minimum of 4 up to maybe about 12 months, depending on the size of the house, the types of finishes, the location, things like that. What we saw in 2021 and 2022 with the pandemic lockdowns and the supply chain constraints was a doubling of those timelines. Well, most of the supply constraints have been removed. Most of the elevated pricings for raw material have come back down, but we still do have labor constraints. We still do have land constraints. And that means that the actual process of building new houses is still more challenging and more expensive because you're paying more for land and you're paying more for labor. But additionally, builders do not build by pulling their wallet out of their pocket and handing out dollar bills, $100 bills, whatever, to various places. Rather, they borrow the money from lenders And then they use that borrowed money and pay off the loans once they sell the property. But borrowed money has become a lot more expensive. It's become more expensive not just for home buyers, but it's become more expensive for home builders, which is why we see now, even though we're looking at a third of the product being sold in the marketplace as new construction, we're still looking at new construction numbers that look like they did in 1991. Again, 1991, that's 2 years ago, 33 years ago. Here in the Las Vegas Valley, when the Las Vegas Valley was a quarter of the population that we have right now. So it's still actually very low levels of new housing construction. So new housing construction is itself not likely to solve the problems that we have in the inventory constraints that we've got. So the three major issues looking forward: existing high interest rates, existing very low levels of inventory, and existing slow building. Even though you drive around North Las Vegas, Valley Vista, Aliante, you drive around the Southwest Valley, you drive around Cadence and Inspirado, and you see a lot of construction taking place. It's true, but that construction is still taking place at the rate that it occurred in 1991. It's not nearly as much as it appears to be. It's a bit more concentrated, but it's not really high levels of new construction. So, what's the likely path for interest rates going forward? Well, I'm going to suggest to you two different pieces of information. The first piece of information is the 30-year mortgage. The 30-year fixed-rate mortgage is generally priced at 196 basis points. That's 1.96% or almost 2%. 2% higher than the 10-year Treasury bond. So the 10-year Treasury bond is a very easily tracked, well-clearing market that we can look at any time to be able to know what the 30-year fixed-rate mortgage rate should be. It should be 2% higher. Well, as the Federal Reserve adjusts interest rates, and it does not adjust the 10-year Treasury, it adjusts an overnight rate referred to as the federal funds rate. That's the only interest rate it actually adjusts. As it pushes that federal funds rate up, the 10-year Treasury rate probably also goes higher. Now, it's not in lockstep for a variety of reasons, including the 10-year Treasury is a free marketplace where the Fed funds rate is controlled by the Federal Reserve. So the marketplace gets to decide what 10-year Treasuries should be doing. As the Fed has pushed up interest rates on the Fed funds rate, the 10-year Treasury had stayed relatively low until recently. The Fed has been talking, we need to be higher on interest rates, we need to be higher on interest rates for a longer period of time, and the 10-year Treasury market has started to incorporate that mantra with increasing interest rates on that 10-year Treasury. And we actually saw earlier this year, 2023, 10-year Treasury rates hitting the highest level they had since the year 2000, 2001. They had actually gone up to well over 5%. Now, the 10-year Treasury over the past approximately 1 month has fallen back to about 4.5%. Now, what that means is the 30-year mortgage, which is currently priced, as I record this, at 7.62%, should actually be priced about 6.5%. So we're 112 basis points too high on mortgage rates right now. So if we think about mortgage rates, if mortgage rates start to normalize to their historical 196 basis point difference from the 10-year Treasury, mortgage interest rates should actually be about 6.5% right now. They're too high. This gap will probably narrow for a variety of reasons, including banks competing with each other to try to get the business of lending money. So that should pull mortgage rates lower. Now, the second rate issue, however, is still the Fed itself. The Fed is trying to use interest rates to kill off inflation. They may or may not be very successful in doing this. I think they're actually being foolish for a variety of reasons I cover in my regular monthly update videos. But it means that the Federal Reserve rate, or the Fed funds rate rather, is likely not going to be going down anytime in the, let's say, intermediate term. Probably not going to see the federal funds rate go down prior to June of 2024. And then it's going to depend on both inflation and whether or not we're in a recession. So assuming the Fed funds rate remains stable, the 10-year Treasury rate will probably remain stable, which means the only drawdown we're going to see in interest rates over the course of this coming year is going to be on the on closing that gap between what 30-year rates should be relative to the 10-year Treasury. Now, what's the likely path for inventory? Inventory is being held very low by a couple of processes. One is there are not as many buyers out there, and so some sellers have decided to hold back. Why bother listing my property? Other sellers are holding back because they're thinking, I'm going to have to get into a higher mortgage interest rate if I sell now. Why do I want to sell now and trade my inexpensive mortgage for a high-priced mortgage? Those two issues are really holding down inventory. Now, if we start to see sales pick up, I suspect we'll just see a corresponding increase in sellers saying, well, maybe now's the time. If we see interest rates coming down, then we'll see some sellers saying, I might be willing to trade my 3% for 6.5%, even though I'm not willing to trade my 3% for 7.5%. And so that's likely to induce some additional inventory into the market as well. Although a 6.5% interest rate on a 30-year fixed rate loan is historically not high, it's still higher than what we've gotten used to in the time period sort of 2005 to actually 2003 to 2021. And so there are not many people who are used to the idea of having to pay interest rates at 6.5%. So that's still likely to hold down inventory somewhat, although not as far as it is right now. What's the likely path for new construction? Current projections, not from me, for new construction from the Home Builders Council here in Las Vegas and some other economists who look at new construction, project new construction of housing next year, 2024, is likely to increase marginally from about 11,200 to about 11,500 units. Now, I actually think it's probably likely that we'll see a little bit more growth in new construction next year. I would project that we're probably looking at about 12,000 units. But remember, interest rates are really high and they're impacting builders as well. And so that's keeping a lid on the level of new construction that's taking place. So we'll see, I believe, some marginal increase in new construction, but it's not going to be a significant factor. It's not going to find us a way out of the low inventory environment that we've actually got, even if new construction continues to be close to a third of the overall housing market in Las Vegas in 2024. So there's one other factor I want to highlight as concerning for 2024, and that is there's substantial political uncertainty in the U.S. Now, normally this is not a great big consideration in this country where it is in other countries, but clearly we have a situation right now and have over the past year or 2 years. Maybe you can go back 3 years and say that we have a heightened level of political uncertainty, regardless of what your politics are. we can look into the environment and we can see that we have less ability to forecast what might happen in the political arena. And that's partly predicated on we have less ability to forecast what might happen in the judicial arena right now as related to major party candidates. It's also because we are having a hard time understanding right now, legitimately, whether or not the US government is going to be subjected to multiple budget-related closures over the year 2024. So we know, as I record this, that the government has been funded through January, basically the middle of January for 2024. But we don't know that Congress is going to be able to actually pass budgets through the end of the fiscal year, the end of September. We don't know if the next fiscal year will be funded. So there is some real uncertainty as related to the political environment. The greater the level of uncertainty could hold back some people from making decisions where they may want to wait and see what's actually taking place before committing large sums of money on the entry or exit from a real estate position. All right, so those are the four major factors influencing 2024: inflation, inventory, new construction, and political uncertainty. So therefore, what do I think that 2024 is going to look like? And remember, this forecast is both general, it's obviously forward-looking, but it's also local. And so I'm talking more specifically about the Las Vegas environment than I am about the rest of the country, although we've actually seen a lot of the country looking pretty similar over the past few years. In fact, a really interesting thing happened during the pandemic that most people don't realize. There have been areas in the US that have shown chronic, long-term housing shortages. Los Angeles, New York City, Seattle, Denver, places that lots of people live, perhaps want to live. They have also experienced high levels of housing price inflation. It's actually not referred to as inflation on housing prices, but housing price appreciation. And increasing levels of homelessness. Because housing has become so expensive, it's unattainable for a larger and larger share of the population in those areas. So we've seen in LA, we've seen in San Francisco, the Silicon Valley area, we've seen in Seattle, Denver, New York City, something really interesting take place during the pandemic. And that is when the economy shut down, people who could work remotely from wherever they happen to want to work from. And this has continued, and so some people have had to go back to their offices. Others have hybrid work where they have to be in the office. Sometimes can be remote, other times. And of course, other people will remain probably remote, who knows, possibly forever, having a really big impact on commercial real estate, especially offices, but has this really interesting impact on housing that most people haven't really thought of. Those chronically underbuilt, highly populated housing environments were able to, and it wasn't planned, it just happened because people made individual decisions, they were able to export their housing crises to smaller markets all across the US. And so you started seeing smaller markets with significant levels of price appreciation and with decreasing levels of affordability and decreasing levels of available inventory and consequently increasing levels of housing distress. And so we've seen it here in Las Vegas. You can go throughout the country to secondary markets and see this phenomenon. And so while the forecast I'm giving here is for Las Vegas, this actually holds true for a surprisingly large portion of the country now, because the pandemic in some way nationalized much of the set of issues that we see around housing, where housing is otherwise very local, has always historically been very local, and in some measures continues to be very local. We just happen to have these national level issues now impacting all around the country at the same time and in the same manner. So the forecast. My forecast is obviously conditioned on the issues I've just highlighted as challenges in the environment, things we need to pay attention to: interest rates, inventory, new construction, and the political environment. Most significantly, interest rates. So conditioned on interest rates, which I believe interest rates will, on the mortgage rate, be coming down probably all year long. On the Fed funds rate, probably coming down in the second half of the year, allowing mortgage rates to drop still further. I forecast we're going to see the number of transactions increasing fairly substantially in 2024 relative to the very low pace we saw in 2023. And so I'm projecting transaction growth of 10 to 15% for 2024. So that's the number of units that go into contract and actually end up being sold. What about with regard to price? So I'm not going to give you a specific price target this year because the interest rate environment is too complicated, partly because the Federal Reserve is chasing its tail, trying to figure out what to do with interest rates. And interest rates, as I said at the beginning, housing price appreciation has been 6.5% from the beginning of 2023 through the end of October, but carry costs have gone up by 23.1%. So clearly the interest rate environment is hugely impactful. And so as interest rates come down, the cost of carry on the same price will come down as well, meaning that prices have scope to be able to go higher if there's more buyers who want to be buying. And so I believe interest rates will be coming down. It means that I'm projecting housing price appreciation, single family resale here in the Las Vegas Valley of about 20% in 2024. Obviously, it's conditioned on the interest rate environment. And if the Fed decides to increase interest rates still further, then that's obviously going to impact the validity of the forecast. It'll pull transaction volume even lower, where we're sitting at basically historically low levels of transaction volume. There are sellers who need to sell. For some reason, they have a job that takes them to a different part of the country or a different part of the world, and they need to sell. Or there's a growing family and they need a bigger house, or there's a death in a family and they need to, the heirs need to get rid of a particular piece of property. There are people who need to sell. Similarly, there are people who need to buy, right? Somebody just gets relocated here because of a job. They're coming here for school, what have you. They're international investors. There are people who are trying to flee China and get their money out of China. Whatever it is, there are people who need to buy. And so transaction volume will never go to zero, but it's down. It's below when the economy was closed for the pandemic. And so I think transaction volume will be going back higher, as I mentioned. But again, if interest rates go higher still, that will curtail many of the, I don't necessarily need to, even though I'd really like to, kinds of transactions in the marketplace. Now, why do I make these forecasts for pretty significant volume growth, 10 to 15%, and definitely significant pricing growth of 20%? So there's a set of supporting factors, and I just want to talk about them for a couple of minutes so you have an understanding about why I'm relatively sanguine about this market. It's not that I just am totally optimistic and I always see that the glass is overflowing as opposed to just being half full. There are actually a lot of supporting, contributing factors that are driving my forecast. One is, while new home construction remains low in Las Vegas, and in fact across the entire country, we're undersupplied housing units about 5 million from what we should have been if the trends from the late 90s had continued, which trends, by the way, were approximately the trends required for replacement of dilapidated property and supporting of population growth. So reasonable trends, not the extremely high levels that we were seeing in the mid 2000s, but rather long-term trend of housing, new construction of housing units. So we've got a gap, right? We were way oversupplied in 2006, but housing starts actually by 2008 had fallen from 36,000 in Las Vegas Valley to 3,800, so fallen by 90% in the Las Vegas Valley. And housing starts did not fully recover from that drop until we got to about 2017, 2018. So we had 12 years of really big undersupply in terms of the amount of building that was taking place in Las Vegas. We ate through the surplus supply, and we've not been replacing dilapidated houses. We've not been building new houses at the rate necessary to accommodate the population growth. Remember, in 2023, we're building the same number of houses we were building in 1991, when the population of the valley was 25% of what it is now. We're underbuilding houses still. So we've got this gap in the valley, we've got this gap nationally. Housing growth, new construction has been undersupplied. Well, in the Las Vegas Valley, that is a very real issue, right? It's 5 million or so housing units across the country. Las Vegas is actually a growing economy. Since 91, we've quadrupled our population. We've grown since, you name it, we're growing every single year. We even grew when the economy was closed during the pandemic. So we don't have enough new construction to actually get us out of the inventory shortage that we're in. And ramping new construction, even if the forecasts for new construction are too light, and we go even past the 12,000 units that I'm suggesting, which would be an increase of about 8% from where we actually are in 2023. Even if we increased new housing construction to 15,000 units, we're still not creating enough inventory. So we're in a low inventory environment, and that low inventory environment cannot be dealt with strictly through new construction. We would need multiple years of rapid ramping. And new construction is being held back by high interest rates. So new construction, or the relative lack thereof, is actually supporting for price growth. We also have some really interesting growth issues in Las Vegas. We actually have just been awarded by a vote of the owners of Major League Baseball, the A's franchise. So the Oakland A's they're effectively no longer. The Las Vegas A's are on their way here. It's going to take a couple years for them to get here, but in the interim, they're going to need to build their stadium. They're going to need to staff front office, back office. They're going to be needing to put in all of the infrastructure. The A's stadium is going to be built at Tropicana and Las Vegas Boulevard. The Tropicana Resort is at that location now on 36 acres. The owners of Tropicana have decided to grant 9 acres. They may go slightly larger, but 9 acres of that land to the A's for building their new $1.5 billion baseball stadium. That means that the owners of the Tropicana will deconstruct the Tropicana and then build a new resort there. So that's a lot of investment that's going to go on that corner. One of the busiest intersections of primary street intersections in the entire US. So really valuable land, going to be getting many billions of dollars of investment. And that's going to start taking place actually in 2024, because we'll need to have the architectural diagrams in, we'll need to have the utilities start to be taken care of. So that's investment money that starts as related to the A's moving here this coming year, 2024. We have championship sports teams. The women's NBA Aces won their championship this year. We've got the Golden Knights won the Stanley Cup this year. So we've got Major League women's basketball, Major League hockey that has come to Las Vegas. And then we've obviously got the Raiders, who built their $2.1 billion stadium and are here in Las Vegas, going to be hosting the Super Bowl in February of 2024. And the Raiders obviously have had a challenge in 2022, had a challenge so far in 2023. Hopefully they're in a rebuilding process. But it is really interesting because unlike in most, in fact, pretty much all areas where you have sports teams, the team's not doing well, attendance goes down. Right? Ticket sales go down. Well, in Las Vegas, we're an economy driven significantly by tourism. And who does not want to come to Las Vegas and get to engage in all of the things that take place here, including going to a football game? So even though the Raiders have not been doing particularly well, attendance levels at the stadium have been maintained at almost 100%. This will be true with all of our sports teams. If we've got a bad year or a bad couple years, we've still got tourists who are going to be filling all of those seats, which means tax revenue from ticket sales will always be high. It means that tax revenues from food and drink at stadiums, at merchandise at stadiums, will always be high. Las Vegas is really uniquely situated with regard to its sports teams, which we keep gaining. Now, Las Vegas is likely to get a couple of things. One is it's likely to get an NBA team. There's a group of investors who are looking to start building a resort on the south side of the Strip that will include a basketball arena, irrespective of the timelines that the NBA may come up with and what team may or may not ever come here. But it gives a home for an NBA team to be able to step into right away. Given the Summer League, the other events that the NBA engages here, as well as the success of the women's NBA in Las Vegas, it's a matter of time. I would suggest less than 24 months in all likelihood for the NBA to declare a team is coming to Las Vegas. Then we've got Major League Soccer, the MLS. It's very likely that the next MLS expansion team will be coming to Las Vegas. No guarantee on that, but I would suggest in a period less than 3 years, we're going to be building another stadium for Major League Soccer here in Las Vegas. Las Vegas obviously just also completed the hosting of the very first Formula One Grand Prix here in the Valley since the 80s, when some strange thing took place in a parking lot at Caesars. And that's the first of at least 10 years of Formula One racing here in the Las Vegas Valley. And of course, we've also got NASCAR up in the North Las Vegas. So this environment has become a real sports mecca, and that brings fans, whether they live here or they're tourists, whether they're fans who want to move here to support their teams or all of the teams. It brings investors, it brings a lot of different things to Las Vegas. So that all represents growth. And this is marginal growth on top of what has historically been the growth areas for Las Vegas, which are conventions, where the convention center is still going through its expansion, and obviously tourism, gaming. So what's happened with tourism and gaming? Well, Red Rock Resorts will be opening the Durango Resort here in the southwest part of the valley, where that represents an approximately $800 million investment in local tourism. And then we've got Fontainebleau finally opening on the Strip after a very long gestation period dating from 2006. will finally be opening December 13th of 2023. And that itself is a $3.7 billion investment in gaming, entertainment, lots of restaurants, and of course some additional convention space. And I'll point out that this is in addition to the post-pandemic openings of the first new construction high-rise resort in downtown, circa a $1 billion investment, and the $4.3 billion opening of Resort World on the Strip right across the street from Fontainebleau. So very major investments taking place over the past couple years, including this year, into new resorts here in the Las Vegas Valley, growing the existing major industries here in the Valley. So growth in the new industry of sports, growth in the existing industries, entertainment, gambling, eating, all of this is highly supportive of population growth, and we see actually significant population growth here in the Las Vegas Valley. The unincorporated Clark County Township of Enterprise, located on the west side of the Strip, all the way to the edge of the valley, and located from Warm Springs south, that's Enterprise. And Enterprise itself has been the #1 growing area in the U.S. over the past several years. In fact, it's kind of interesting because it's the largest of the rapidly growing areas. So it's #2 in terms of growth in percentage terms, but it's #1 in growth of actual numbers of people who are moving here into Enterprise. So significant. Also, the Wallet Hub study indicated that both Henderson and the unincorporated Clark County Township of Spring Valley are also among the 25 most rapidly growing areas in the U.S. So we've got significant population growth, and that's continuing. And that population needs housing. Then we see significant job growth, right? And it's partly associated with professional sports. It's partly associated with increasing numbers of resorts and casinos. It's partly associated with increasing food scene, drink scene around the valley. But it's also increasingly associated with medical care. UNLV has opened just a couple of years ago their medical school, and the campus on Shadow Lane downtown has just opened. So significant dollars being invested into the growth of higher education, and in particular into the growth of the medical field here in Las Vegas. And by the way, people who are coming for sports, people who are coming for the medical field, people who are coming for a lot of these other types of jobs that are growing, are being paid substantial wages. And so they're supporting the totality of the economy here, including wanting housing, and sometimes, maybe frequently, housing that's sort of in the upper half of the cost strata that exists in the housing market here in Las Vegas. I'll comment, in fact, just slightly further, and that is the Culinary Workers Union has just negotiated a significant multi-year contract with most of the resort companies along the Strip. And while we don't know the details of that yet, these are significant increases in wages, which are well earned and certainly deserved. As we see actually these new resorts opening, we're going to be creating more jobs than we've ever had in hospitality here in Las Vegas. And these are going to be significantly paid jobs with better wages than what we've been seeing historically here in the Valley. And by the way, while hospitality-related jobs have lagged since the economy started reopening post-pandemic, they now exceed the numbers that we saw in 2019, where all other employment categories in the Valley exceed and have exceeded for quite some time that 2019 level, and in fact exceed even the rate of growth that had been trend line above 2019, we've grown above that trend. So we do not have an employment problem here in Las Vegas, other than perhaps we have a shortage of certain skills, like construction skills. Now, the other supporting factor is the interest rate environment, where I believe that we're going to see mortgage interest rates spread narrow from the approximately 330 basis point spread down to that 200 basis point spread that historically we look at. And so decreasing mortgage interest rates should also be supportive of the housing market. So those are the issues that are really supportive. Job growth, employment growth, lowering interest rates, and significant new investment in resorts and in sports here in the Las Vegas Valley. Now, there are some risks to the forecast. I just want to highlight those real fast to you. One risk is continuation of high inflation. If inflation should come back, which is certainly a possibility, because inflation is actually being driven by demographic change in the environment, with millennials entering into their prime spending years, irrespective of what the Federal Reserve wants to do. If inflation comes up, increases further from where we are at the 3.2% at the end of October, we might see the Federal Reserve either holding interest rates higher for a longer period of time, or maybe even increasing interest rates still higher than what they are now. Now, again, it's a loose coupling to the mortgage interest rate, but certainly if the Fed funds rate goes up, that may induce the 10-year Treasury higher, and that may induce mortgage rates higher. And anything that causes mortgage interest rates to go higher will, of course, be a negative and will be a drag on the forecast that I'm making. I don't think that's going to happen, but it is a risk to the forecast, so I will highlight it. Next, continued high interest rates, even of themselves. The Federal Reserve has been very clear that they are not nearly at that point in time where they're contemplating lowering interest rates, and they're thinking they need to hold the interest rates high for a long period of time. And that puts a floor under mortgage rates, where mortgage rates really are not going to go below the historically 200 basis point spread to 10-year Treasuries. So we could see mortgage interest rates drop by 130 basis points, but they're not going to go lower than 6.5%. in the current interest rate environment as associated with the Fed funds rate. So just simply maintaining interest rates, not terribly bad, but it's a risk to the forecast I'm providing you, in the sense that it puts a floor under where rates may go. Next, possible recession. And I would even say probable recession. I was at a real estate conference in November of 2022. High-level agents from all across the country, as well as some number of loan officers. And the person putting on the conference asked in the audience how many people think that we are already, in November of 2022, in a recession. Over 80% of the agents raised their hand. It was kind of interesting, and I was in that category. So the economy has actually been more resilient than I suspected that it was going to be. But it's likely, especially if the Fed does increase interest rates at all further, that will push us into a recession. In fact, if we look at economy-wide statistics over the past 2 months, we see the economy significantly slowing. Car sales are coming down, retail sales are coming down, new construction is coming down, government investment is in some manner flat, where realistically it should have been going up, going higher. And we're seeing other indicators such as somewhat increasing levels of unemployment numbers or first-time claims filing numbers every week over the past month. So the number of new jobs being registered in the economy has been decreasing. It's still positive. October to 150,000 approximately, but that number has been decreasing for each of the past 4 months. And so we may see unemployment actually start to go higher. And that, of course, may induce savings, which may induce lack of spending, which may induce recession. Now, that's a risk to the forecast, but it's not a risk in the sense of the call on pricing. It's a risk in the call on numbers of transactions, because if people are unemployed, it's harder for them to make the commitment to buy a house. It may be that they have less incentive to sell a house because they don't have another job lined up somewhere that's going to accommodate their sale of the house and subsequent purchase. But we actually see a correlation between existence of recession and housing prices is negative. It's small, but it's negative. So existing recessions tend not to pull prices down. They tend to witness actually slight increases in price appreciation. So it's kind of interesting because that might cause you to ask, well, wait, does that mean if the economy is growing, prices will come down because of negative correlation? No, it's actually negative correlation with recession. So if you have a recession, housing prices are negatively correlated. If you have growth in the environment, housing prices are marginally positively correlated with growth in the environment. It happens that if you look at housing prices, there's a very long-term trajectory. Housing prices go up year over year over year over year, with very few exceptions, unless you look for areas of the country that are depopulating, such as the Rust Belt, which depopulated from the 80s through the 90s, the 2000s, the 2010s. We saw prices go down in those environments. Those are long-term trends. They may be steep occasionally. Usually they're just long-term trends down. In growing environments like Las Vegas, actually Las Vegas is rapidly growing. In growing environments that are growing slowly, we generally see long-term price appreciation in housing. It's just simply a truism. It's one of the most stable assets that you can buy, and it shows small levels of price appreciation every year. In a rapidly growing area like Las Vegas, we can get fluctuations around that long-term trend. We may have a year or two where prices come down. We may have a year or two where prices are going up by 20, 30%. So we actually have seen since the beginning of 2020, so just before the pandemic lockdown, and just a couple months ago, so approximately where we are in pricing now, single-family home prices in Las Vegas over that 2.5-year period of time are up over 45%. Right now, that's a really high level of growth. I think that in 2024, we're going to have a really high level of growth at about 20%. It could slow. If there's a recession, it could slow. We'll still see price growth, but it may be slower. And then, as I alluded to earlier, political environment. There could be some political crises. We certainly have experienced several over the past couple of years. It's possible we experience some additional ones associated with government shutdowns or riots or problems in the execution of judicial mandates. These are concerning, and that level of uncertainty may deter transactions. Again, not terribly likely to cause pricing to come down, although it's possible, but it might slow the rate of growth, both in pricing and in number of transactions. Two other things real quickly. One is appraisal risk. I'm going to also label it regulatory risk. We've seen over the past 3 years now, since 2020, very high levels of contract failures associated primarily with bad appraisals, where an appraisal comes in low, buyer can't or will not make up the difference in cash, seller is not willing to cut the price to make the appraisal. To the extent that the regulatory environment around appraisals is broken and is not being fixed, it means that we're going to continue to have bad appraisal problems going forward. And so every time a transaction fails, house has to go back in the market, seller looks for a new buyer, or the seller pulls the house out of the market entirely, figuring, I'm not going to bother risking this kind of thing again. And so that can pull down the number of completed transactions. And so that does create transaction volume risk. It creates a little bit of pricing risk because there could be some possible declines in pricing to try to ameliorate the problems associated with bad appraisals, although more likely there's going to be more creative workarounds about how to try to get around appraisers so that appraisers cannot screw up deals. The other one is possible dislocation in the real estate agency business. There's been some very weird litigation that's happened recently. I'll do another video on that probably by January. But it may be that it's going to become harder to find qualified real estate agents to actually help you through your transactions. Transactions tend to incur a great deal of inertia, resistance. Even if there's a willing buyer and willing seller and both parties really want the transaction to work, transactions do not just happen, they do not just close on their own accord. They require pushing forward of a whole lot of stuff that requires the active work of agents. And so to the extent it may become more challenging to find real estate agents, either because of some weird litigation issues or because of such low volume of transactions that some agents decide to leave the industry because they cannot put food on the table with the amount they're making, then that actually could make transaction volume increases more challenging and may cause us to start seeing some level of decrease in transaction volume is sort of a vicious cycle. So what it means is recommendations with my forecast. One, I recommend you work with a qualified real estate agent to try to help mitigate those problems that do interfere with the actual closing of a transaction. I recommend you work with a real estate agent so that you understand how you should be pricing your property, because if you're pricing too high, you're probably killing yourself in this environment. If you're pricing too low, you're probably giving away stuff you don't need to give up. If you're priced properly in this environment, you may even find you get multiple offers, but you're going to have to be priced properly. There's tremendous resistance among buyers when there's high interest rates because they look at a number and they figure out what their cost of carry is. Their cost of carry at the beginning of November, 23.1% higher on the exact same home than it was at the beginning of 2023. So as a seller, you have to accommodate that issue. Doesn't mean you need to lower your price or go with a low price. Work with a qualified, knowledgeable real estate agent who can help you around these issues, because they're not necessarily obvious issues and the workarounds are not necessarily obvious, but they are out there. There are transactions that take place and those are successful. Also, you want to work with a qualified real estate agent who understands about prepping your home for sale or prepping your own buyer profile if you're a buyer, so that you can actually work through the likelihood of getting into contract in addition to the likelihood of getting through the contract. So those are my recommendations, earnest recommendations, and again, the overall forecast, subject to the risks I've highlighted and for the supported reasons that I've given you, overall volume growth 10 to 15% in 2024 and price appreciation 20% in 2024 for the resale market here in Las Vegas Valley for single-family homes. If you find this video to be helpful or useful, please smash the like button, hit the notification bell for more videos that I produce. Every month I produce a series update, a single-family residential resale home market update, and a companion for condos and townhomes market update, as well as some additional videos that I do for other interesting information. Again, also please share these videos with anyone, friends, family, neighbors, colleagues who you think might benefit from the information contained in these presentations. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. I look forward to seeing you in the next video. Thank you.